The Indian stock market faced a black Monday today with tariffs from US President Donald Trump causing a significant downturn. In fact, Indian markets ended in red today. The tariffs imposed by US President Donald Trump on over 180 countries across the globe have unleashed an economic war. While India has indicated that it does not plan to retaliate against Trump's taxes tariffs, the knock-on impact from a slowing global economy and a potential US recession are expected to keep apprehensions high. But how serious is the situation? What should the investor do? That's what we asked tonight. We're getting you best voices. But first, here's a report from NDTV Profit.
It's expected to be a tough day of trade. Global cues suggested it. We slipped below the 22K mark, but we've recovered fairly decently in that sense. 500 plus points from that day's low is how the Nifty has recovered. So that's quite a bit of turnaround. Within the Nifty, IT was the pack to watch out for. Nearly 2,000 points up from the day's low. We've closed 2.5% down for sure. But the bounce from the day's low was very, very sharp. And even if I can pull up quickly an Infosys, it will show that it's one of the stocks which has really recovered from the day's lows. Infosys, TCS, those were 2-3 counters which have done very, very well within that IT pack. And the recovery from the day's low was extremely sharp on some of these counters. Also, when you're contextualizing auto, a Tata Motors was one of those which has been hurting and reeling under tariffs. Again, the recovery from the day's low was very, very sharp within Tata Motors in particular. Nifty Auto a bit, but Tata Motors in particular, from 535 we've gone and closed at 582. So a very, very sharp recovery at that, where Tata Motors is concerned. But let's talk about the Nifty 50 basket of stocks. And within that, FMCG was the one area which was okay. And you'll see HUL leading that. Nestle also down just about 1/3%. ITC largely down just about 1%. Trent was the one hurting. Commodity stocks and Nifty Metal was the one big casualty for the day. Let's pull up the sectoral heat map as well. And within that pocket, we'll see that the big movers were Nifty Metal, Nifty Realty within the broader markets, and Nifty Auto, which is down 3.4% nearly. Nifty Bank largely in line with the Nifty 50 index, but pain points all around. Nifty FMCG down 1.1 odd%. So that was the one outlier. Nifty IT down 2.5%. We did speak about that. The Nifty Pharma was down 2.8% as well. So that one in focus. Last off, I want to also talk about the breadth. The breadth was extremely weak as expected, but we saw a bit of recovery right towards the end. So 172 advances to 2060 declines. It was a painful day of trade overall. Broader markets, I want to quickly zoom in on those. We saw recoveries from lows. Nifty mid cap and small cap also saw sharp recoveries from those lows. 17,269, we saw 800 points of recovery there. And the Nifty small cap as well. From 13,300, we've closed around 900 points higher. So all of those seeing a bit of recovery from the lows, but nonetheless, pain is elevated at this point. Clearly 4% lower despite that. Those are the top gainers and losers. Siemens, there's a special situation, but outside of that, plenty of them. Delivery, of course, making that acquisition.
Okay, joining us now is Sanjay Ashar, who's a senior partner at Crawford Bailey & Co. Manish Tangi, who's the CEO and founder of Mosaic Asset Management. We have Professor Santosh Mehrotra as well. Thank you all of you for joining me on this broadcast. To you, Sanjay, first, Sanjay Ashar, tell us, why such a savage market reaction to Trump tariffs? Was this expected? Because I was looking at numbers in the last 2 days of sell-off, in fact last week, US shed $8 trillion in market value. Such a sell-off would actually take anybody to COVID pandemic days. What does the investor have in this? How should he or she prepare for something like this?
One, because of the policy by the Trump government, and WTO has been kept by the wayside, and there is no clarity as to what are the tariffs going to be, and which is why it's going to affect the exports from India or elsewhere as well. So therefore, obviously, the Indian companies will face some or the other trouble because their exports would be impaired considerably. And what the market, as I understand, is factoring the exports which the Indian company will be able to make because of the tariffs imposition, not only from the short term, but also from the medium term perspective. And so therefore, obviously, it is going to affect the market. As far as the investors is concerned, I don't think there is too much to worry. Maybe there might be some further fall, but obviously, of course, I'm not a market expert in that sense, but surely they should accumulate more stocks on every fall.
Right. Mr. Tangi, experts have noted that the market fell today mainly due to what can be called a disconnect between how the US is looking at reciprocal tax regime and also how the market is viewing the same. How should the investor look at this unusual environment of tariffs and retaliation? Will this create more uncertainties? Will it keep the market uncertain and vulnerable till further announcements are made? Mr. Dangi?
Are you asking me?
Yes, Mr. Mahesh Dangi.
Okay.
Yes.
Sorry. So my sense is that, it's a large reason why. Let's get the structure of the markets right first. The Indian equity markets typically sort of correlate very well with US markets. On a 90-day moving basis, near 90% correlation. So in some sense, it's not an endogenous, it's nothing to do with India. It's, if US markets, do the way they behave, of course, Indian markets will also act. Now, US markets typically, again, actually fall by about 30-35% on average if there is a recession. Okay. So historically, over last 100 odd years in US, an average market fall has been about 35% for every US recession. That sort of tends to occur once in 10 years. Now, right now, it is a very unlikely event that US will not enter in a recession. And that is why markets sort of have moved from one extreme until about 2-3 months ago that there is a MAGA, which is like, let's make America great again, tax cuts and, potentially the AI boom, to, inevitability of a recession, and which is why such a swift reaction. Okay. So we have already given up. NASDAQ has given up about 20%. And S&P is about 16-17% down. But if it's an average recession, you will end up having 30-35% off. And of course, all markets, including India, would actually act on it. So in a sense, there are no loose ends here. Everything is related. And finally, what sort of is the mother market, we call it, which is US, which is 60-65% of the world markets. If this behaves in the manner it behaves, of course, all markets will fall. And that in turn is very well tied with the US economy. And that actually is likely to get into recession, is what markets bets are. Not just equity market, bonds are also betting this. Crude is betting it. Crude has fallen off substantially. Copper has fallen substantially. And so has S&P 500 and NASDAQ have fallen.
Okay. Professor Mehrotra, so is the threat of trade war and resultant recession or the apprehensions around it real now? How should India prepare for this, or should we look at this as a time that will just pass?
This time will take at least 3 years to pass. At the very least, I'm sorry to say. Unless Mr. Trump is chastened enough by the hammering in the midterm elections to the House of Representatives. The House of Representatives goes to the polls in 1/3 of the House actually gets polled again. Now, but the after effects will remain for 3 years. There is going to be a massive reset, and I completely agree with Mr. Dangi. Let's just recall how the global markets have behaved. I'm going to give you some numbers from stock markets across the major markets. Hong Kong fell by nearly 14%, Taiwan by 10%, Japan by nearly 10%, Italy by 8.5%, and I could go on all the way down to France at 6 and UK at over 5. And in this list of 20, India fell by 4.1%. That means we are at number 17 in a list of 20. So we are completely correlated with the rest of the world. Because there is just no question that the US is going into recession. No question at all. If that was not the case, in 1,300 cities, ordinary Americans would not have turned up across the United States. It's not that it is red states versus blue states. It's across the United States. 1,300 cities saw protests by ordinary people because they are expecting inflation to go up dramatically. Their taxes are not going to be cut, not for them at least. And if inflation goes up and jobs do not grow, as they are not likely to grow, they've been doing okay so far, then you can understand what's going to happen. In that case, how would India prepare? That was your question to me.
Yes.
Well, firstly, we have to diversify our export markets. Just no question about it. Secondly, we have to negotiate hard with the United States in the trade agreement that we're. Okay. And thirdly, domestically, we have to have an industrial policy which is much more focused on the micro, small, and medium enterprises, so that jobs grow. If jobs don't grow, domestic demand will not revive. Domestic demand doesn't revive, private investment is not going to go. Please recall that the private investment rate in the last 10 years has been, we might keep congratulating ourselves about the fact that we're become the fifth largest economy. Fact of the matter is, private investment is at a 10-year low. The range investment to GDP has been in the range of 26% to 32% in the last 10 years, compared to the preceding 10 years of 4 to 14, when it was between 32% and 38%, despite a global economic crisis. And what we are about to see, that the whole economy is going to go into crisis. Global economy is going to go into crisis.
Okay.
We may have to up our fiscal expenditure, because we'll have to put in place a fiscal and a monetary policy stimulus. All of this going to cost us very dearly. And honestly, it requires a reset. It requires a domestic reset. Because let me tell you what's happening in Europe. I'll finish, Mr. Dangi, very, very briefly, if I may, just in 30, 40 seconds.
Right.
You see, Mark Carney was the Bank of England was president, was the chairman. The man who has become now the Canada Prime Minister.
Right.
He knows Europe. Canada is already talking to Europe. Europe is extremely pissed off. If you heard Trump today, Trump has said, oh, we are not only not going to talk, you will not only pay for us now on your tariffs, but you will have to pay for your past sins, all that sort of thing.
Okay.
I mean, here is a president who's gone bonkers. Bonkers.
Okay. Manish Dangi, you wanted to, taking off from what Professor Mehrotra also said, what kind of reforms are needed in India to cushion this blow and also to prepare for times that are clearly unprecedented?
No, when US is reforming, we only need cushions right now. So, in a sense, reform by nature is, perversely though, is in near-term painful, okay? We're going to have enough pain in next 6-12 months. There are a couple of points I want to make here. I think what Mr. Mehrotra said, if this were to continue for 3 more years, forget about 3 years, if it continue, this limbo setup that we are in right now continues for 6 months also, an unimaginable liquidation is on our way. So in a sense, for your audience to sort of get a sense that nothing of this sort has happened in last 50 years, 60 years.
Absolutely.
So in a sense, this is not a routine COVID virus has come, or Indian economy has slowed, or some small tariff actions that Trump did in the first term. No, this is a gigantic shift. It's a reversal of the neoliberal policy that Reagan and Thatcher had put out back in 80s. So in some sense, it's sort of very, very large. 6 more months and massive liquidation. Now, I'm a markets guy here in this panel, okay? So I have to tell you that markets are going to, bleed red, okay? Like never before, that's number one. So I think, close maybe in couple of weeks, okay? Some sound bites should come, which actually is somewhat soothing, so to say, purely from a market point of view. Right. Number two, on the India standpoint, I think there are 3 or 4 bullies out there, which is China, US, to a certain extent Europe. I think we are a very small economy and likely onlookers right now. Frankly, we really don't have much degree of freedom. So I think, wait and watch is what our political approach will be, policies approach will be, sorry. And I think simultaneously a little bit of a soothing by way of deep rate cuts, little bit of a policy support, that India fiscal or monetary can give, that bit, would be coming our way.
So before I go to Sanjay, Manish, one more question for you. Just give us some practical advice, because, how important is it for the investor to remain calm in situations like this? Because I was reading up on this, they say avoid panic selling, continue with your SIPs. All of us have SIPs. Consider buying quality stocks. But give us some practical advice. What is the best way forward for investors?
So if you're an SIP, then this is the time that you had done SIP, So remember this, So don't sort of do a sabotage to SIP, because SIP's very mechanism is that you ought to buy it cheap, and you're likely going to get cheap markets, So a little bit of a sale right now, And so therefore, in next 3-6 months, you must accumulate so that average that you had bought at higher prices, you actually get to averages better, So if you're an SIP investor, don't watch much of business news, continue with the SIP. If you're a timing investor, then, it's best that you wait out, because there is a lot of policy uncertainty right now. And you're sitting on cash right now, it's still time. Let the volatility drop. There are measures like VIX, will begin to sort of soothe a bit. Political or policy voices will come to support market. Likely RBI and Fed will have deep rate cuts coming in next few weeks, by the way. Fed should cut rate by 50 to 100 basis points, maybe within few weeks.
Right.
All of that will come, with alarms on newspapers, and your channel will be telling investors. Perhaps, that is why you could actually dial up equity if you're a timing investor.
Okay.
But for an SIP guy as you are,
Yeah.
I know you must continue, and forget about all that is happening right now in the world.
Okay, thank you so much. Sanjay Asher, what would your feedback be in this regard? Because, Donald Trump has indicated that he's not concerned about market losses. This is his, reaction that has come in the last 1 or 2 days. He has in fact said that foreign governments would have to pay a lot of money to lift sweeping tariffs that he has characterized as a medicine. Where do you see things going from here, sir?
I think some sense will prevail, and considering the uproar which has happened all across the world, I think there would be a respite, and I don't think he will go further while then he's already gone. So I think it's almost over now from his side, and I think the things should get stabilized. And as far as India is concerned, the sheer Indian domestic consumption and the Indian market should help us. So the investors, to my mind, should not panic. The primary market should continue with raising money, and the domestic investors should get an opportunity to invest. And once the domestic market and the primary investment keeps happening, I think India should be able to withstand all of this.
Okay, Professor Mehrotra, what is likely to be the end game here, sir? I know that's a difficult question, but can a resolution happen with just minor bruises, or is better sense going to prevail? What is your prediction? And we keep talking about silver lining. Is there an opportunity somewhere there for India in this whole crisis that's going on?
Very difficult to say that we have an opportunity. It is true that Vietnam and China have faced much larger tariffs, but that's not really the point. Our problems for our exporters are domestic. We are not at the cutting edge of technology. We have not invested very much in expanding capacity. Now we are being told, the textiles and tariff on China and Vietnam are much higher than on us. Big deal. Are our manufacturers in a position to actually scale up? The vast majority of our manufacturers in garments and textiles are actually relatively medium or small scale manufacturers. You never see in India a garments or apparel manufacturer who's sort of 4,000, 5,000 employees, which is normal in Bangladesh and of course normal in Vietnam. Forget about China. So point is, we don't have the capacity to take advantage, even though that Vietnam and China have much higher tariffs imposed on them. So this is why I'm saying this is the time to lie low. And because it's a global crisis, and because demand even for our software exports is going to fall off, because global demand is going to fall off, it's a time to focus, because we are a relatively small player. Manish is absolutely right. We have to focus on building up our domestic market and creating the right incentives to ensure private investment revives. Focusing on public capex is not going to do it. If it was going to do it, it would have done it. And every year lost for us is a year lost from our demographic dividend. Our demographic dividend is slipping away.
Right.
One other point, very briefly, if I might. You see, we haven't spoken about how the Europeans and Japan and the Commonwealth countries are reacting. They are reacting. Even Starmer, even the United Kingdom of all countries is up in arms. Please try and appreciate what is their reaction. They are thinking, oh, we need to reconnect with Europe. And Europe will reconnect to a much greater extent with China. And this is going to cause a massive reset in trade and economic relations over the next 2 to 3 years. I'm convinced of that.
Okay.
Sorry for taking
closing remarks from you, Manish Dangi. You know, people have been talking about volatile markets, but they've also been suggesting stronger risk management. Would you advise investors to also constantly monitor global cues now, because that has become very important?
No, to an average investor, I would only advise that don't position size beyond your capacity. Equity, please remember only one sentence here, that equity is a market which will see a 20% drawdown every 3 years, about 50% drawdown at least once in 10 years. Typically, every 1.5 years later, you have a 10% drawdown. So equity tends to be extremely volatile. You're getting a taste of it right now. This is routine, for markets, who people who've been there in the business. It's in some sense the way equity is responding right now. From a policy standpoint, the reason why equity is falling is unique. But equity keeps falling for all kind of random things, And so to that extent, just ensure that don't overextend yourself, So there is one sane advice that you also made, that let's continue with SIP. But then second advice is that focus on your business, your job, work hard, save money. Part of it, allocate here, but don't overextend yourself. This is not your mantra to become, quick rich. This is not going to make you. This is going to make you 3-4% more than your fixed deposit if you are disciplined, patient, and stay invested for very long.
Okay, that's great advice. Thank you so much, all of you, for joining me on this broadcast. Indian markets have taken a major hit on Monday with fears of a global trade war growing after US President Donald Trump announced tariffs on all countries. But of course, experts on the show have advised all investors to maintain calm and focus on discipline and on investing stocks that they know, and also on monitoring global cues. With that, it's time for a short break. More news and updates on the other side.